Imagine your retirement portfolio is a massive apple orchard,
Okay, I like that visual.
right? And when it's time to actually live off that land, do you just eat the fruit that naturally falls from the branches? Or do you slowly chop down the trees and sell the timber to buy groceries?
It really is the ultimate retirement dilemma. You've got the psychological comfort of a natural yield versus the mathematical efficiency of total return.
Exactly. And according to a new Martic finance analysis we're diving into today, picking the wrong strategy could mean you need an extra $150,000 just to clock out of the workforce.
Which is a huge difference.
Yeah, massive. So today's deep dive is pitting dividend investing directly against broad index funds. We want to see which is truly more sustainable for your retirement. And quick disclaimer, we're just looking at the mechanics here for educational purposes, so not giving financial advice.
Right, right. So let's look at the apple orchard first. The dividend approach. The appeal of holding those classic aristocrat stocks that hike payouts every year it's pretty obvious.
Getting paid cash just to hold a stock.
Right. But the reason this specific strategy has such a cult following among retirees really comes down to behavioral psychology. Like, when a bear market hits, watching your total portfolio value plummet is terrifying.
Oh, absolutely.
But seeing hard cash still hit your brokerage account every single quarter, it acts as a behavioral anchor. It basically prevents panic selling at the absolute bottom.
But that comfort isn't free, right? I mean, that's the hidden cost Martic Finance points out. The fruit isn't just magically appearing out of nowhere.
No, it's really not.
Every time a company pays out a dividend, its stock price actually drops by that exact amount. The value is literally just moving from the company's balance sheet right into your pocket.
And triggering a taxable event along the way,
Right, exactly.
which creates massive friction. You are bleeding compounding power to taxes year after year, even if you just automatically reinvest that cash.
Yeah.
And worse, it tempts investors into yield chasing. You see a 9% yield and think it's a gold mine. But structurally, a yield that high usually means the stock price has collapsed. The market is pricing in a massive risk of the company failing entirely.
So if dividends drain stock value dollar for dollar, create constant tax drag, and tempt you into value traps,
Which they often do.
you're basically taking on serious individual company risk just for the illusion of free cash. That makes the mathematical efficiency of total market index funds look like the obvious answer.
Yeah, just buying the whole market.
Right, you capture that historical 8 to 9% total market growth with practically zero fees.
The mechanics of the index approach are incredibly efficient. By selling just 4% of your shares annually, the classic withdrawal rule, the underlying growth naturally outpaces your withdrawals over the long haul.
You're mathematically replenishing the timber you just chopped down.
Exactly. But there is a catch.
Wait, really? What's the catch?
Well, earlier you said selling off shares during a market crash is terrifying.
Yeah, because it is.
Right. So if you're strictly in index funds, generating no natural cash, and the market tanks 25% the day you retire.
Oh, I see where this is going. I'm forced to liquidate shares at rock bottom just to pay my mortgage.
Precisely. It's known as sequence of returns risk. If you are forced to sell shares when prices are deeply depressed, you have to sell a mathematically larger chunk of your portfolio to generate the exact same dollar amount.
And those shares are gone forever. They can't participate in the eventual market recovery.
That is the Achilles heel of the total return strategy.
So we have two flawed strategies here. How do they actually stack up when you run the numbers for a real retirement scenario? Because Martic Finance ran a showdown for generating $50,000 a year in sustainable income.
Yeah, the math is pretty revealing. On the dividend path, assuming a realistic, safe 3.5% yield without taking on crazy risk, you need a $1.4 million portfolio to generate that 50 grand.
Okay, $1.4 million.
But with the broad index fund approach, utilizing that 4% withdrawal strategy, you only need $1.25 million.
Wow. That is a $150,000 difference in required capital.
The pure math definitively favors index funds. They require less initial capital, provide superior diversification, and generally offer faster long-term growth by avoiding that constant tax friction.
Yet, despite that $150,000 penalty, so many retirees still fiercely defend the dividend strategy.
Because human psychology heavily favors dividends. Not having to manually log in and hit the sell button during a severe recession might actually be worth the mathematical inefficiency.
If it keeps you sane, right?
Exactly. Ultimately, retirement portfolios don't usually fail because of a 0.5% drag in tax efficiency. They fail because of human behavior.
Like liquidating everything in a blind panic.
Or going all in on a dying company just because it promised an unsustainable yield.
It really all comes down to knowing how you'll react under pressure.
It does.
So think about that apple orchard one last time. If long-term investing success ultimately relies more on managing human psychology than maximizing pure mathematics,
Which it almost always does.
should you be designing your portfolio to squeeze out every last dime of wealth, or to protect yourself from your own worst instincts when a storm hits the farm?